Okay, now that we have the basics of life insurance, kind of what it is, why someone would need it, the types of life insurance, it's probably good for us to take a kind of a deeper dive into it and look at specific contractual provisions that we'd see in life insurance that we might not necessarily see in a property casualty or a health insurance contract. Now, there's a little bit of crossover here, so what I want to do is kind of focus on the things that are more specific to life insurance when it comes to contract side of things, okay? Right, so a couple of things. One, with the ownership clause, so what this states is that the policyholder really at the time of the policy owns all contractual rights while the insured is living. So keep in mind, yes, these are face value contracts, but also on top of that, when we see these being assigned, the evidence of insurability is not really needed at the time of, in this case, death being the loss. Okay. Now, the entire contract clause pretty much states that it's only within the contract, with only in this realm, that we agree to this from the insured to the insurer perspective. So nothing really outside of that. So it's the beginning and the end to the agreement between those two parties. And then additionally, this is something new, is the idea of the incontestable clause. So in most states, this is a 2 year time period. Some states it's 1 year. So 2 year time period that gives the insurer, the insurance company, a way to kind of verify if there's a misstatement of fact or if there's something wrong in the policy. After that 2 year period, there is really no reason that this policy can be kind of backed out on. That the life insurer can say, well, no, 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 we're not going to cover that because you lied on this application. After that 2 years, doesn't matter. The policy is good, and the burden, is really only shifted on if there's a loss, through death or something like that. Okay. Couple of other things. So we've mentioned the grace period and reinstatement clause when we talk about health insurance and lapse policies. It's a little more generous with life insurance policies. And again, if you can go in to your agent and say, or your broker, whoever you utilize to get the life insurance policy, if you can go into their office and say, hey, I'm late, can I pay on this? They're not going to be like, well, wait a minute. Did you suffer a loss? Like, no, you're alive. You're there. You haven't suffered a loss. Okay. So usually it's 31 days. For reinstatement clauses, it can be a little bit longer, up to about 90 days. Now, something here to think about now, frankly, quite morbid, but something to think about. We also see a suicide clause. So the face value will not be paid within the incontestable period. The face value for the first 2 years will not be paid if the individual commits suicide. So something to think about here is this a moral hazard or an adverse selection, issue? Now, we would say that with adverse selection, we kind of want something ex ante, right? So prior to taking on the policy. So if someone goes into a life insurance policy, they pay their premiums with the intention, okay, of committing suicide, then we would probably argue that that's going to be adverse selection there. It could also be a type of moral hazard, right? But if it's preemptive, then it kind of falls under the umbrella of adverse selection. Well, moral hazard would be a little bit different. You don't buy the policy with intentions to create the loss via suicide. No, you buy the policy and then maybe after the fact things change. Okay, and then you decide because you have the policy, you're not as worried about your retirement plans paying out for your beneficiaries and your children. You're like, no, they'll have the money. So now you're just gonna, commit suicide because you have this kind of protection, this financial protection here. So something again morbid, but interesting to think about nonetheless. Okay. All right. Now, what if we're in this incontestable, period, this 2 years? What can cause a contract to either be drastically changed or completely dropped? Well, the first one is the misstatement of age or sex, because when we're looking at life insurance contracts, the underlying risk is heavily dependent, or mortality tables really, they're heavily dependent on these two ideas. So how old you are, right? As you get older, your risk of death, it increases. Now, of course, we can talk about conditional probabilities, but we discussed that in the prior chapters. Now, misstatement of sex, what we'd really like to see here, what we notice is that individuals who essentially have a Y chromosome, who are male, they tend to die sooner, right? So there's a risk associated there. So beneficiary designation. This would be when you're looking at the contract, you say, all right, I have a primary, so usually we'd say spouse. Okay. Contingent, yeah, could be, your children, be a contingent beneficiary. You can also have revocable and irrevocable. Okay, so revocable is easy to change at any time. Irrevocable is the opposite. It's not easy to change. It's stuck within the clause there. Now, why you might want an irrevocable is if some reason this policy was assigned to someone else, but you still want the beneficiary to get the same payout. You can also do specific or class beneficiaries. Specific would be like a named beneficiary. Okay, this is my child, Jonathan. Okay, whatever your kid's name may be. Specific, your child and his name, his or her name. A class beneficiary would be children. So any of my children. Now, when you can kind of fall into some mistakes here is if you have a class beneficiary and you say, or excuse me, a specific beneficiary and you name your current spouse, then let's say you get divorced. Well, you might not want them to get that policy. You could want them to get the face value if you pass away, right? So it might be better sometimes to have a class beneficiary, though other times it might be better to have a specific named beneficiary. There's also an addendum here called the change of plan provision. So we talked about endorsements and riders, but a change of plan provision would let the policyholder exchange their present policy for a different contract. If they want more or less coverage, they've already shown their evidence of insurability, so generally they can roll it from one to the next. Now, there's some limitations here, from term to whole policy or different types of universal life policies, right? But for the most part, there can be a change of plan. Again, because you've already shown some evidence of insurability and there's not much, it by way other than age or sex that's going to change your risk. Now, a couple of exclusions here. So, war is excluded. Now we have SGLI, which is the servicemen and women's general life insurance, which also provides a little bit of health insurance too. So there's coverage for that for those that serve in the armed forces. Also, this is generally considered a catastrophic loss or very high risk loss too. If a country is at war or someone's participating in it. There's also aviation exclusions. It tends to be a relatively a high risk job, at least when it comes to life insurance. These are quite limited now. Aviation exclusions, that is. Payment of premiums, you usually have a choice annually, semi-annually, quarterly, or monthly. So, for example, the policy that I have, it's monthly, and I pay it, every other paycheck since I'm paid every 2 weeks. Okay. Now, an assignment clause. So keep in mind that life insurance policies can be freely assigned by the owner. Okay. Either way, right? So This is always provided. It's rarely limited. Okay. So they can assign it as they see fit. Okay. Now, keep in mind that whole life policies have cash value to them, so you can actually loan against that. You can use it as collateral or you can borrow from it via the insurer. You can also set up an automatic premium loan. So this is if you're past due, okay, to keep the policy in force, okay, to pay the premium is going to be taken from the cash value. So this would be great, if someone just simply forgets about their coverage but wants the coverage, right? So the automatic premium loan can be quite beneficial. There are also dividend policies, right? So we talked about a little bit about mutuals and the payout for dividends. So if we have a participating policy that will be offered as maybe part of a mutual, you can select to get dividends back as cash, premium reduction. You can accumulate them, right? And there will be some investment to be gained on each of those. You can use it to pay for certain endorsements or riders, so additions to the policy, or you can add excess insurance on top of that. So maybe you have 100,000 whole life policy, but you have a new kid, right? And you think that your needs are a little bit higher, so you get a term policy for 20 years to add on top of that base whole life policy that you do have. Okay. A couple of non-forfeiture options that we want to discuss here. All right, so keep in mind that policyholders pay more than their risk for the beginning, right? Because the premiums are level in some of these policies. Okay, so they're paying more than their risk initially, and then once we get a certain point, later in life, they're paying less than their risk, right? So the example we used in chapter 11 is if you're paying $100 for a life insurance policy at the age of 27. When if it goes in force and it's full policy, you'll be paying the same thing at the age of 77. But obviously your risk has drastically changed. Your risk of death has changed. Okay. So that being said, since you're paying up more, you're entitled to receive something back if you do surrender the policy. So you kind of get that. It's not always the cash value, it depends on state, but a lot of states have, all states have some type of non-forfeiture law, meaning that the policyholder is going to get their money back, because there's a whole policy tied to cash. So it could be cash. They can do reduced paid up insurance. So the premiums they paid up to this point will cover for X amount of a whole life or a term life policy. So there are a couple of options there if the individual just cannot, pay. And then finally, settlement options. So when there is a loss, or if someone lives to the ripe old age of 122, which sounds more like a curse than a blessing. But so what happens? So how do we get this money back, right? How do the beneficiaries get it? Well, there are a couple of choices. They can get it in cash, and from a time value of money perspective, you want the lump sum initially there to do what you can. And the thing is most people are not that great at managing money, and they have a windfall of $100,000, $200,000. It probably be better served to be in someone else's hands managing that money for them. That's why we have interest options in which the amount is held and the beneficiaries are paid interest on it. They still have the amount, right? But they're just accumulating and collecting interest. It'd be a fixed period option. So this means we're just going to pay out for 20 or 30 years, however long the funds may, or however much the funds may be. We're going to evenly partition them out over the fixed period time, so 20 years, 15 years, whatever it may be. Then there's a fixed amount option that says, all right, well, we're just going to give them $500 a month until the money runs out. Okay, so that we have two kind of fixed options here. Can also take a life income option. Now, this is going to shift a little bit of the burden onto the insurer, because they're then going to be guessing, all right, well, how long is this beneficiary going to live, right? So this is kind of where we get to the world of annuities, which we haven't covered yet, but we're getting to the world of annuities. So we're concerned about longevity risk from a financial perspective. So if you do a flat life income option, then the estimate there is how long this beneficiary is going to live. Okay, if it's longer than we think, okay, then we might not be at a good NPV perspective. If it's less than we think, then we might find ourselves in the black, so to speak. Okay, so we can add addendums to these, right? If we're worried that it's not going to be enough, we can say there's life income with guaranteed period or a guaranteed total amount. Okay, so pay them lifetime income, the beneficiary in this case. I want them to get income or at least 20 years. Okay, whichever comes last in this case. We could also say life income with a guaranteed total amount. So life income or $250,000 worth of coverage. And then finally, we can have joint survivor income of the beneficiaries that can be tacked onto that. Okay, now there are some pros and cons to taking these. Now, I started out by saying that a lot of people, could not manage $100,000 or $200,000 well, and that tends to hold true. Okay, so what we would get by a settlement option is, okay, great. We have this kind of periodic income being provided to the family. It can't be as mismanaged as if one person just kind of has, kind of a stranglehold on it. Principal and interest are guaranteed. This is still the beneficiary's money. Okay, and they can help in overall life insurance planning. And then again, like I said, that insurance windfall can create problems. If it's more money, if it's $500,000 or $1 million, there could be some infighting across the family on who gets the life insurance payout, right? But if you're already set, hey, it's a life income with guaranteed periods to these two or three people, well, won't be as much fighting there because they don't have a lot of choice. Okay. Now, disadvantages. All right. As I've said numerous times now, you should not look at a life insurance policy as any type of savings vehicle. Okay, it's a pretty poor savings vehicle, but it tends to be safe. So we know that risk and return tend to have a relationship. We've discussed that ad nauseum in this class. Okay, so you can make more money elsewhere, but you do not buy a whole life policy to as an investment or to make money. Okay, think of it as a risk transfer contract that just happens to have a savings element tacked on. Okay, and that savings element should not be something that you focus on, and nor should it really be something that in your mind adds a lot of value, despite what your agent may want to tell you. I'm sure his or her commissions are very high on whole life policies. Okay, and then again, these life income options do have, yeah, limited usefulness depending on the age, right? So if it's a lifetime payout, if it's $100,000 stretched out from the time that this beneficiary is 15 to the age of 65 or 75, that $100,000 is going to be a very small amount on it paid out monthly. Okay, so it does depend. Okay, a couple of other things I want to add here to kind of round out our discussion on life insurance, at least an introductory course. So there's the waiver of premium provision that's always available. So if an individual becomes totally disabled, okay, they can start they already have access to, or excuse me, they do not have access to that. But premiums can be waived if they become totally disabled, right? Because they're no longer able to work. You can sometimes borrow against that. Sometimes it will pay out sooner, especially with an accidental death or terminal illness. Okay. It's also a guaranteed purchase option, which lets the policyholder buy additional amounts without evidence of insurability. This is again going to be a rider or an addendum. Okay, but you have shown evidence of insurability for the most part. And then finally, we had the accidental death benefit rider that can pay up to 2 times the face amount if we have what's called an accidental death, and that will be defined in the policy. An example was auto accidents. Okay, so death in an automobile accident is almost always considered an accident, and there could be others as well. Generally, workplace accidents don't count. Okay, generally speaking, those do not count. So workplace accidents do not always count. Okay, a couple other things here. We have a CPI adjustment, right? So a dollar today is worth more than a dollar in the future, right? So what we would do here is say, well, that $500 we want to promise to pay out in a month might be okay now, but 20 or 30 years from now, it might be worth the equivalent of $300 or $200. So it would be relatively speaking worth less due to the time value or due to inflation. There's also accelerated death benefits riders. So I mentioned this previously. So if you are terminally ill, then really you can collect the face value. This was meant to kind of cut down on the kind of viable settlement market and stranger-owned life insurance policies we saw in the 80s, which is when we had a lot of mostly young men contracting HIV and then it going into AIDS. And there would be investors who would say, oh, well, but if you name me as a beneficiary on your life insurance policy for, let's say, $500,000, I'll give you $100,000 right now to do that. And what happens when this unfortunate, young man passes away? Yes, he got the $100,000. It was his choice. There's nothing illegal about this. The investor then makes, a net of $400,000. So to kind of combat this, right? Because we could think that there'd be a lot of people that would think that'd be a little seedy. I would find myself in that category as well. Okay, so to combat this, we have the accelerated death benefits rider for if you are terminally ill. So HIV, AIDS would definitely count. Cancer definitely falls in that. Any type of terminally ill, terminal illness. Okay, and then life settlement here. That would be when the policyholder who no longer needs the policy can sell to a third party. So it's still the policyholder's right to sell. They own it. Okay, and it's assignable, as they see fit. Okay. All right, well, that's going to get us through the wild and wacky world of life insurance contractual provisions. If you have questions, as always, reach out to me and let me know. And thanks.